We are here to talk about a jurisdiction which is inside India but actually considered a foreign jurisdiction.
Filing tax returns in a foreign country, and or taking tax credit of that return of the tax which has been deducted in a foreign country is not a very happy situation.
Actually, 2005 was
2005,
the
so almost 20 years back, so they set up. 25 years back, this number was 1 lakh crore, So it has basically grown 80 times in the last 20-25 years. The Gift City Fund basically eliminates all this. So it becomes like any other jurisdiction. You can invest in dollars, you can withdraw your dollars, you don't have to file your tax returns in India. There is no TDS which is applied on your returns. The problem is of choice, isn't it? If you are wanting to invest for 5-10 years, 20 years, then multi-manager is the right thing to do. Monitoring is 80% of investing actually, and people don't realize. There's a very bright chance that we may do better than your own selection. Indian capital markets will remain the best performing markets in the world. If they don't have India in their portfolio, they are making a big mistake.
Hello and welcome to another episode of Beyond Just Returns. This time we are here to talk about a jurisdiction which is inside India but actually considered a foreign jurisdiction. A very interesting subject, which is Gift City. So I have with me Mr. Raghvendra Nath, Managing Director of Ladderup Asset Managers. Welcome to the show, sir.
Yeah, thank you, Pasa.
So, sir, let's talk about Gift City. There's a lot of noise about Gift City. People are comparing it to global jurisdictions. People are calling it the India's maiden IFSC, which is yet to make rounds in the global roundtables, etc. What is all this noise about? What is Gift City, and why should we be interested in that?
So, traditionally, whatever money was flowing from institutional investors in India, foreign institutional investors in India, was coming from multiple jurisdictions: Singapore, Mauritius, Dublin, Luxembourg. And most of these jurisdictions basically made investments very, very easy. They created some tax exemptions for investors in those jurisdictions, and which made them very, very popular. Because, we need to think about this from a foreign investor's standpoint. If an investor, let's say in US or Canada or Australia or let's say Germany, has to invest in India, then he would like to have a situation where he doesn't have to pay taxes in India.
Right.
Whatever tax liability he has, he may settle it in his home country. But filing tax returns in a foreign country, and or taking tax credit of that return of the tax which has been deducted in a foreign country is not a very happy situation. And so most investors globally look for such places, or such vehicles which are in such countries or jurisdictions which have these tax advantages.
Got it.
So like India traditionally has been getting money from Mauritius through the Mauritius route. And Mauritius became popular 20-25 years back, and as India was getting liberalized. So most of the money, most of the foreign institutional investors' money came through that route. So people started establishing funds in these countries, and investors will participate in these funds, and those funds will then invest into India.
Okay.
So Indian government, I think, the Gujarat government came with this idea of setting up a international financial center many years back. I think it was 15 years back.
Maybe. Actually, 2005 was
2005, so almost 20 years back, so they set up. But any such thing needs a threshold level of activity to become popular. what has happened in the last 10 years is that, the government of India has given certain exemptions to, funds which are getting established in Gift City. And that's why it has now got, a lot of interest from fund managers in India as well as abroad.
Got it.
And but Gift City, coming back to Gift City, it is like any other financial center.
Okay.
Like Dubai set up DIFC, which is Dubai International Financial Center, with a similar intent.
Okay.
15 years back, and it was again set up 25 years back. First 10, 15 years, there was hardly any activity. But if you look at probably last 10 years, almost every single bank has set up a branch there. Every single audit firm has a branch there. Hundreds and hundreds of wealth managers have come about and have set up shop there. And so it's basically for all residents in UAE and GCC. DIFC has become kind of a trading hub or a financial hub. Hopefully, Gift City will be an answer to that, from an Indian perspective.
Interesting. Now, talking about actual numbers, because that's what is the proof of the concept. There are already more than 250 funds established in Gift City. A lot of business is being generating. If you could throw some insights into how the business looks like, and has that transition happened, or is that pathway set for transition towards this becoming a successful business hub?
So the good news is that the money markets in India have been thriving. I think our market capitalization of Indian capital markets is around $4 trillion, probably the third or fourth largest in the world. Okay. Our debt capital markets are pretty deep again. Billions of dollars, trillions of dollars get raised in Indian debt capital markets. So, and already mutual fund industry has gained a huge amount of traction in India.
True.
I think combined, the total assets of mutual fund industry is now around 75 lakh crore. I think almost 80 lakh crore, which is touching $1 trillion. Okay. 25 years back, this number was 1 lakh crore, So it has basically grown 80 times in the last 20, 25 years. So the industry is creating traction, and industry is now basically is getting into that stage where not only Indians, they because of the track records that they have created, various asset managers, PMS industry is around 3.5 lakh crore. AIF industry in India is another 2-3 lakh crore. And there are hundreds and thousands of asset managers now who have created track record, and they want to utilize this track record to market India to the world. Okay. So one of the key advantages of Gift City will be these fund managers who are basically establishing an entity in Gift City for the purpose of inviting capital into India.
Got it.
And that's going to basically, it's right now a trickle. I think total around $10-12 billion have come into India through this route. And a lot of outbound funds have also, have taken place. But I think this inbound funds will keep growing in size and intensity. And like you mentioned, around 250 funds, already 120, 130 fund management entities have set up. We are also setting up an entity now. And again, we have big plans for Gift City. I think most fund managers are looking at this vehicle very, very seriously. And probably the activity in that place will only grow from here. Because now, that basic level of activity has already started happening. All the banks are there, the audit firms are there, technology companies are there, infrastructure has got created, fund management companies have set up shop, fund administrators have set up shop. So now you have that ideal conditions where more and more people can start accessing that
Understood.
jurisdiction.
Fair enough. So now there's a lot of benefit that you've mentioned about the fund management entities or the service providers, the entire ecosystem. How about the investor now? Is there enough being done to attract investors, especially NRI investors, because they form a huge chunk of potential investors for these funds?
So NRIs, and then I think I would say the real success will happen where a lot of foreign investors start flocking to Gift City funds.
Right.
Okay, that's when we would have become truly successful. Okay, and I think one the government has done is to basically accord the same level of preference to Gift City that they have done in DTAAs with various countries. So let's say Mauritius has a double tax avoidance agreement, DTAA, you know, with India.
Yeah.
Same is with UAE, same is with Singapore. Now, these DTAs were harmonized around 5-7 years back, okay? Whatever income tax benefits were accorded or they were to these in these DTAAs, the same benefits have now been accorded to investors who are investing into these Gift City funds, you know, through various amendments in the Income Tax Act. And that's something which has been which has been probably the reason why this activity has started.
Fair. Understood. And even what you were mentioning about the filing of tax in your home jurisdiction or not requiring a PAN card. So operational efficiency also comes with due course of time, but
yeah, that's a very big factor actually, and especially for NRIs. Considering that we are an asset manager, we have been facing tremendous resistance from NRIs to send money to India. You know, so just imagine that if they have to open a PMS account in India and NRI, first he has to open a bank account, then he has to open a trading account, okay, and a demat account, along with a PM agreement with a PMS provider. Then he has to send his dollars to India, you know, so he pays an exchange rate there. And then, whatever investments are done, there is a TDS which is applied on everything, all short-term gains, all long-term gains by the broker, all dividends by the companies because he's an NRI. And then he files his tax returns. Right. When he has to take the money back, again, he has to convert his rupees into dollars. You know, so for somebody who's sitting thousands of miles away and he has no connection to India other than these investments, this becomes a big hassle. Okay. And we have been facing this hassle, you know, and so the Gift City fund basically eliminates all this. So it becomes like any other jurisdiction. Today, if a person is sitting in UAE, let's say, or any GCC country, or let's say even places like Singapore or any other place, Europe or any other place, their investments, they are global citizens, they are global investors, and therefore they are investing across and fluidly. There is no restriction which is being put in place for them. You know, if let's say if I had to invest into US markets, US government said first you have to give your passport, then you have to give your PAN card, then you have to file your tax returns, then you have to open a bank account. Will I ever do?
Fair.
Okay. It is not possible. And so whatever, because NRI is such a large population for India, obviously Indian government and, the authorities, they want certain policies and procedures. But good news is that Gift City doesn't have all that. You can invest in dollars, you can withdraw your dollars, you don't have to file your tax returns in India. There is no TDS which is applied on your returns. So all that becomes a big benefit because you become part of the homogeneous community. Because a Gift City fund can take money from a foreign national, can take money from a foreign entity, and can take money from NRIs. All three get the same treatment. Like today in India, I can't take money from an overseas corporate body. Not allowed. Okay. So if there's an NRI who has a company and he has the money in the company and he wants to invest that funds into India, he cannot
Fair enough.
because of the tax laws. So all that will be possible now in Gift City.
Gift City. Got it. And you were mentioning about the India's burgeoning financial market and the ecosystem. For people to access, for example, the mutual fund industry or the best of the managers that we have here, is multi-manager approach something something that you've been talking about? Is that the right approach to go? And what could you just demystify that entire process for us?
So Ladderup has always Ladderup started as a wealth management firm, and therefore the idea was to basically pick and choose the best managers in the country for our investors. And the idea was simple. There are hundreds of fund managers in India who are managing public money. Okay, each one of them is capable. And I always give this example of, IPL, Indian Premier League. Okay. There are almost 200, 250 players who play in IPL. 75% are Indians. All these young boys, 18-year, 20-year-old. Last year, there was a 14-year-old. All of them are capable to play in the Indian cricket team, isn't it?
Fair. Absolutely.
But Indian cricket team can only have 15 players.
Fair.
Now, who's going to decide which are these 15 players out of these 150 who have played in IPL and hundreds who have not played in IPL, but they are equally capable. So the problem is of choice, isn't it? And only a very experienced selector can say that, okay, we want Abhishek Sharma.
True.
Or we want, Shubman Gill, to be part of the team, and not, let's say, somebody else, who has been who's far more senior or aged. And same is the case with the wealth managers. So we were doing that for last 13, 14 years, and we have done that very, very successfully. True. Where year after year, our selections actually did very well. And even, if one or two funds did not perform well, we could change those funds before they could do damage to the client's portfolios.
Got it.
So multi-manager is a very, very beautiful approach, actually. And especially when you are looking at a country.
Okay.
So from an NRI's perspective or a foreign national's perspective, let's say, an NRI who's living in Germany is interested to invest in India, and he keeps reading about news and gets excited about the economic activity in India and says, let me partake in it. What can he do? At best, he will, maybe if he's very conservative, he'll buy an index fund to participate in Indian market, but that index fund will always have a tracking error.
True.
So if index produced 12% return, he gets 11.5, Or if he comes across one or two managers who are celebrated and he sees there some videos or some TV or whatever, or he gets into contact with them, he'll invest with them.
Correct.
But he doesn't know where do they stand in the pecking order,
True.
whether they are the best managers that he can hire. So that approach will always have inefficiency.
Fair.
A multi-manager approach takes care of these inefficiencies.
Okay.
Because you are investing in 12 to 14 active managers.
Okay.
Each of these managers are trying to beat the benchmark. Now, not all of them will beat. And we know that, that 30, 40 managers every year are not able to beat the benchmark. But the other 60 are.
True.
And when you are picking and choosing managers out of hundreds, you basically apply a proprietary process and all that to find out which are the managers which have the highest probability for outperformance, And that's what we have done for last 13, 14 years. Every asset manager may have their own approach. And we have also created an approach which has worked very well for us, which is a mix of quantitative and qualitative data. Quantitative data helps us in shortlisting managers, and qualitative interaction with the manager, looking at which sectors where are likely to do well, what's the exposure of those sectors in this fund and all that. All those things help us in basically picking and the shortlisting finally who do we want to deal with.
Got it.
So within large cap, we'll pick up 2-3 managers. Within mid cap, we'll pick up 2-3 managers, and that way, multiple things happen. One, an investor gets exposed to all segments of the market.
Fair.
Okay. So if small cap does well, he has money in small cap. When mid cap does well, he has money in mid cap. His money is diversified across 12 to 14 active managers.
Correct.
Let's say 80% of them outperformed, 20% underperformed, Even then, the ratio is in his favor.
Fair.
Which means that at an aggregate level, his portfolio beats the market,
Got it.
So that's second thing that happens. Because, we are selecting managers who have the highest probability of outperformance. And the 2-3 managers who have not been able to outperform, if their underperformance is unbearable, unsustainable, then we replace them with better managers.
Okay.
So, and that happens on a proactive basis in 6 months' time, in 9 months' time, I don't know when. In last 14 years, we have changed around 18 managers.
Okay.
In the selection pool. So 1.5 managers in a year, so which is not much. But that out of those 18 changes that we did, 15 actually went right.
Interesting.
So the managers that we chose ended up doing far better than the managers that we replaced.
Okay.
So it works in the favor of investors. So a multi-manager strategy is a very sustainable strategy of participating in equity markets from a longer term. If you are wanting to invest for 5-10 years, 20 years, then multi-manager is the right thing to do.
Got it. And there's the power of continuous monitoring also, because I'm assuming an investor or even an NRI, for example, who's sitting back there in Germany, doesn't have the time, bandwidth, or even sometimes capability to assess the market at every point in time.
In fact, Upasana, that's true for most investors who are following this do-it-yourself model, And I somehow, always feel that there's so much inefficiency in that model, do-it-yourself, because you are trying, you invest, and then you forget, There's just no way you can week on week, month on month monitor your choice versus everything else out there. That's not how human beings are made. Let's say you are buying a TV in a shop, you can find it, okay, there are 5 TVs there, the sound of this looking better or the picture of this is brighter. But then you bring a TV home and then you forget about the rest of the 4, isn't it? You don't go and replace that TV. Yeah. And same thing happens with funds most of the time. Forget funds, even stocks. I have investors who have a 50 crore portfolio, or I know investors, they are not our investors. We are trying to make them our investors. So they have a 50 crore portfolio invested in 400 stocks.
Wow.
And they have never ever sold a stock. Okay, they just buy.
Correct.
And they keep. And, how can this approach now yield returns? Tell me. Okay. Now they're making only market returns. But there's so much inertia that they just can't basically think of selling stocks because they have so many. What to sell? If somebody were to analytically look at their portfolios, they will say, sell 80% of it.
Wow.
And then they will say, no,
Correct.
I don't want to. So they just get stuck. With that. So I think a multi-manager strategy, because it's very dispassionate and it's in the form of a fund.
Right.
Then the fund manager, instead of looking at individual components, let's say stocks or fixed income instruments, as the case may be, is now looking at funds. So every day the fund gets monitored. What is the return? Every week it gets monitored. Every month the portfolios are analyzed. Every now and then the fund managers are met with. So if there's an underperformance, you are able to identify it early.
Got it.
And then you are basically then monitoring that. If that underperformance is, if it continues and it becomes worse, there'll be a point in time which will say, okay, abhi bahut ho gaya, let's try and shift to something else. And so it helps a lot. Monitoring is 80% of investing actually, and people don't realize.
True.
Picking up a good investment is only 20%, because most of us are, will make that mistake. You are basically, every time you're making an investment, you are crystal ball gazing.
True.
Okay, you are just looking into the future, that this will happen, that will happen, telecom will do well, consumption will do well, energy will do well, something, you are just making a supposition and an intelligent guess based on data available. Not everything will go right. Chances are you will go wrong 50% of the time.
True.
Okay. But you go wrong, the 50% that you go wrong damages your portfolio lesser than the other 50% which you have gone right. And the 50% times where you have gone wrong, because you are a professional, you basically exit those investments before the damage is done. Because you realize that, okay, whatever I had estimated or guessed or forecasted is not going according to the plan.
Got it.
So you get out, which from an investor's perspective will never happen.
Fair. And now talking about the performance side of it as well, I'm assuming that all the benefits of monitoring, continuously taking care of the portfolio, all that is an inherent part of what should be done in a good investment. But how about the performance side of it? How do you monitor that? How do you ensure that that's in line with what the investor would be happy with?
So, I think all investors have one common objective. Okay. That, and every fund manager has one common objective. Okay. One single objective, that let's beat the market. If the Nifty is giving 10% return, can I generate 12% sustainably or 13% sustainably? The best chance of basically outperformance, and sustained outperformance is with a multi-manager strategy.
Okay.
Because you are exposed to multiple areas of market.
True.
You are investing with multiple managers. You are investing in multiple investment styles. And therefore, if one style is not working, rest is working. If one segment of the market is not working, the other segments are working. If one manager is not working, the other managers are working. So the chances of basically creating an outperformance becomes more. At the same time, I can say that, let's say you may find that one unique manager who could beat the market 100% of the time. That will not happen in a multi-manager strategy because you are averaging out. Okay.
Fair.
But it is far better than doing index investing. That is for sure. And that's what we have done. We, in fact, at Ladderup Asset Managers, we got ourselves audited recently.
Okay.
Our, the mutual fund investments that we did for last 14 years, and for every single investor.
Okay.
So we had done some 4.5 lakh transactions, 4,40,000 transactions in last 14 years. These transactions were extracted and given to an auditor. And, we have had a outperformance in every single period, whether it's 1 year or 2 years or 3 years or 5 years or 10 years or 14 years. It, we to give them 14 years of data, and every single year there's been an outperformance.
Interesting. And
I'm not trying and saying that, this will happen, but the point is that there is a probability that, because of the approach.
Correct.
The approach is such that there is a probability that you will end up beating the market more often than when you are investing with a single manager, one manager or two managers.
Got it. And how about we keep talking about this predictive model that you've built in-house? Could you enlighten our audience about that?
Yeah, so this performance that I was talking about is for that predictive model. It's for want of a better word or word or phrase, we call it predictive. The idea is that instead of looking at past performance, look at probability of future performance. Okay. Most of us basically have a recency bias. So if I were to tell you that, okay, here is a fund which has given 20% returns in last 3 years, and there's another fund which has given 12% returns in the last 3 years, and you have to choose one of them, you will generally choose the 20% guy.
True.
That कुछ तो अच्छा किया होगा उसने, कुछ तो अच्छा होगा. That's why he gave 20%. The other guy was equally capable, but he gave only 12%. So most of us basically, and the best investors in the world are get influenced by this recency bias. Whatever has been the past returns in last 1 year, 2 year, 3 year, they give undue weightage to that. Okay. And all of us know that past performance is no indicator of future. In fact, the guy who has given 20% returns, odds are against him.
True.
Versus the guy who gave 12%, because most of his portfolio stocks are now trading at expensive valuations.
True.
That's the reason why he gave 20 in the first place, isn't it?
True.
He didn't do any magic. And therefore, the odds are against him. That's how we are built psychologically. So this predictive model has actually done quite well, and that's what encouraged us to basically, create it in a form of a fund. So we did it in the PMS that we run now, or for the last few years we have been running, and which has worked quite well. And we thought that let's basically offer it to NRI and foreign nationals who may be looking at India, and that's how this Gift City fund concept has born.
Okay.
So we are now in the process of setting up the fund.
Okay. So now coming to the benefit that the investors accrue, if I were to ask you that what are the top 3 points why should an NRI or a global investor look at this multi-manager fund, OneUp multi-manager fund, what would be those top 3 points?
Yeah, so we are calling it OneUp multi-manager. We forgot to mention. And the reason for the OneUp is that there's a very bright chance that we may do better than your own selection. And that's how the word OneUp.
Okay.
And multi-manager, obviously, because it's a fund of fund.
Correct.
And the reasons why people should look at this is that, one, India is in a very, very good place right now. Next 10 to 12 years, Indian capital markets will remain the best performing markets in the world, like they have been in the last 10, 12 years, because of the structural play in India.
Okay.
So if you don't have India in your portfolio, you are missing a big piece. So don't go by past returns again. Everybody invested in US and made money. I think India is the future, and you should have 20-30% of your equity investments in India.
Got it.
And if you have to choose India, then rather than investing in an index or with one manager or two managers, a multi-manager strategy can be far more efficient.
Okay.
And which has also a proven track record. And in Indian markets, not in Gift City. And the third is that the entire ease of investing in Gift City is as good as investing in Singapore or Mauritius or Luxembourg, and therefore and it's a very stable jurisdiction. So just imagine 120 funds are already set up there. Almost $23 billion of commitments have happened, and therefore it's a very, very safe and efficient jurisdiction, and hassle-free. So if you want a hassle-free experience and you want an outperformance in long term, then probably investing in a one-up multi-manager makes sense.
Fair enough. So let's talk about this predictive model that you've built in-house. Please enlighten our audience about what this model is and how does it impact the product that you have or are launching in Gift City.
So, Upasana, we are launching this fund, which we call OneUp Multi-Manager Fund of Fund. Okay, fund. Basically, it's a fund of fund.
Okay.
And we call it OneUp because we feel that we can do better than your individual efforts. Sitting thousands of miles away, you can at best pick up an index fund, or you can pick up maybe one manager or two managers.
True.
And a multi-manager approach could give you better outcomes than that.
Got it.
Okay, and when it's basically managed by a team of professionals.
Fair.
And this strategy has been tested in Ladderup for last 14 years.
Okay.
So when we started recommending mutual funds, and we needed a method to select funds out of hundreds of managers. And so we created this, which we call predictive model. The idea was simple. There are more than 230 managers in India now in mutual fund industry alone, by the way, who are managing equity funds. There are more than 500 equity funds. So how do you pick, let's say 10 or 12 or 15 managers out of this 250? It's a problem of choice.
Absolutely.
Because every single manager who's in the industry and who's managing money is capable.
Fair.
He has 10, 15, 20 years of experience. He's well qualified. He has got trained in markets for 10, 15 years. He has worked as an analyst. He may be managing money for last 5 years, 10 years. All of them are very, very experienced people. Okay. It's like IPL, Indian Premier League. We have almost 150, 170 boys who play cricket in IPL. Every single one of them is capable of playing in Indian cricket team. But only 15 people or 16 people can go.
Make it.
Okay.
Sure.
Can make it. Okay. Out of which only 11 will play. So how do you pick up those 15 guys? It's a similar problem with funds. Okay. And so we created a model. Most managers, there are hundreds of wealth managers in India. Everybody has a model. We also created a model. Instead of basically having a basket approach, we said, let's be more specific.
Okay.
Rather than giving choice to investors who may have very little knowledge of these funds, let us make those choices for them.
Okay.
So within large caps, we picked up 2 funds. Let's say in mid cap, we picked up 2 funds. In small cap, we picked up 2 funds. So out of 35, 38 large cap funds, how do you pick up 2 funds? So instead of relying on past performance, which most people do, we decided that let's basically figure out the probability of outperformance in future.
Okay.
Okay. And that we decided that so we created a quantitative and qualitative model, quantitative from a standpoint of statistics and numbers to shortlist, and then verify those shortlisted managers by having face-to-face interaction with them, analyzing their portfolios and looking those portfolios relative to each other. So that's the qualitative bit. And then select these 10, 12 guys, But relying on probability of outperformance in future it has worked out far better than looking at past returns, because past returns are past, and every fund manager, fund house, chillate rehta hai, fund, past returns are not indicator of future. But most people don't listen,
Fair.
If I gave you 2 funds, one is a 20%, one has generated 20% last 3 years, and let's say one has generated 12%, you will automatically pick up 20%, And because you think that guy is probably better placed, more intelligent, he has taken the right call, so whatever. You assign higher capability score to the guy who has done 20 than to the guy who has done 12.
True.
Okay. True. But that's random. All of us know that, past performance has just no bearing.
True.
There are funds which were number 1 in the last year, let's say previous year, and then they become number last, they are at the bottom. And this happens with very, very good frequency. In fact, just come to think of it, this guy who has generated 20% has odds working against him. Because most of his portfolio has given better returns, which could just mean that his portfolio is far more expensive than the guy who has basically generated just 12%.
Sure.
And therefore, it could just happen that the stocks which the other guy is owning end up doing better in the next year. But it's very, very random. What I'm trying and saying is, you just can't make a judgment or decision between whether 20% is better or 12% better. You need to do better than that.
Got it.
And so we have created this methodology, which is proprietary, which is like worked for us for last 13, 14 years. And it has produced very good outcomes for our investors, And so we got ourselves audited recently. And, in last 14 years, we have generated something like 440,000 transactions. Not generated, basically. Our clients, investors have basically done these transactions in and out and all that across all equity funds. So we gave this data to an auditor, and he found out that in almost every period, whether it's 1 year or 3 years or 5 years or 10 years or 14 years, our methodology, basically our investors, the actual returns of our investors, this investor pool that we have, was far better than the markets.
Okay.
So, so this strategy somewhere, basically the selection and all that, worked for our investors. We are hoping that the same strategy can do well in a fund environment. So we have created a PMS also with the same strategy for Indian investors, and which is running for last 6 months, and it's actually doing quite well. In last 6 months, again, it's like basically outperformed the market.
Okay.
And we are hoping to do the same with this OneUp multi-manager fund of fund.
Got it. Quite interesting insights. Now, moving on to what's in it for the investors. If I were to ask you, what are the top 3 reasons that any NRI or a global investor should look at OneUp multi-manager FOF, what would be your top 3 reasons?
So the first is India. Okay, India is in a great place.
Okay.
It's never been better, and I think all of us know about it. We have been talking about it. The global markets have been recognizing that. The weightage of India in MSCI Emerging Market Index was 8%. Now it's gone to some 16-17%. It's doubled in the last 4 or 5 years, and it will keep on going up.
True.
Okay. India was the best performing market in the world in the last 12 years. It will remain the best performing market in the next 10, 12 years. Because for one simple thing, it's a structural play, and it will continue to unfold. Okay. The growth rate, India is today the fastest growing economy in the world. And I think we have the right policies, processes, environment, entrepreneurial spirit, accessibility of capital, good regulations to ensure that this 6.5-7% is sustained over a very long period of time.
Got it.
Okay. And therefore, every single investor in the world should look at India very seriously. If they don't have India in their portfolio, they are making a big mistake.
Okay.
I would say they should have at least 20 to 25% exposure to Indian capital markets. And we are not a small capital markets,
True.
Capital market. Our market capitalization is $4 trillion, okay, which is growing. Every year, hundreds of companies are getting listed on the exchange.
True.
And they are raising, 2.5 lakh crore, which is almost like $40-50 billion every year. Okay. And that money is, getting, so the capital markets the total market capitalization is only becoming bigger and bigger, and the markets are becoming deeper and deeper.
Sure.
Okay. So India today, and has fantastic regulations, So from all standpoints, growth, regulations, depth of the markets, India is a fantastic place.
Okay.
And if, foreign institutional investors own almost $800 billion of Indian capital markets, then why should not individual investors, NRIs, living across the world should own India?
Got it.
So India should be part of their portfolio. Second is that the current regulations for Gift City are very, very, very efficient.
Okay.
Very kind of easy, and because you don't have to file tax returns in India,
Correct.
you don't have to convert your dollars into Indian rupees. So it is as good as investing in any other country or any other jurisdiction. If you were investing in Singapore or Mauritius or Luxembourg, it's as good as investing in any other place. Okay. And so it is very easy. You will find it very, very efficient. And the third reason is basically the approach. This approach has been tested in Indian environment for last 13, 14 years. And it's worked well. And therefore, we hope that it's going to work well in the fund form as well. This fund could be a very good way of accessing Indian markets.
Got it. Interesting. I think we've had a wonderful conversation, and I'm sure the audience has learned a lot about how they could access the India growth story truly, especially through the most efficient way to invest in the mutual fund markets. So thank you so much for enlightening our audience with these insights.
Thank you, Upasana.
Thank you so much for watching. I'm sure you're also intrigued about Gift City and the OneUp Multi-Manager FOF as a product. Do leave your comments if you want to know more or want to share insights on what other topics would you want to learn or understand about. Do subscribe to the channel and let us know more about what you would want to hear about.